Hi there, welcome to Kneppy Invest. Time for my weekly technical update. We're recording this on 9th of October, which is a Saturday, and the overseas markets have come to a completion, and we saw a pretty big down day on the American markets because there was some actually good economic news. And at this point in time, we don't want good economic news in the equity markets, and I'll talk about why in a few slides. Also look at 6 ASX companies, including Core Lithium. This was a request from a viewer, wanted me to do an update on Core Lithium. And the 5 other companies I'll be featuring in this video include Transurban and Telstra, fairly similar looking charts for both those companies. Air New Zealand, possibly sentiment in that company is starting to shift around. And if I had a choice between Qantas and Air New Zealand right now, I'd probably pick Air New Zealand. However, in saying that, I'll more than likely not choose either one if I had an absolute choice. Circo, unfortunately for shareholders, looks like the share price has broken down below a support level. And Donaco International, which is a company that owns some casinos somewhere in Southeast Asia, and there is possibility that share price is breaking out. And I think those casinos have been closed for a while, and maybe there is some good news on the horizon for that company. Before we have a look at the 5 or 6 individual companies featured in this video, I'm just going to have a close look or quick look at the XJO, which is the ASX 200, and the NASDAQ in the next slide. And it's really interesting because it did look like there is a possibility that the XJO has reached a double bottom, which is a good, I won't say powerful, but a good reversal signal. And the first bottom was reached in the middle of June. And recently we saw the second bottom reached. And that was, I think, on Monday. Monday, what's today's date? The 8th. So that would have been Monday, the 3rd of October. And it was really interesting on that day because the bottom was reached during the day, not at the open or the close. And then as soon as the bottom was reached, fairly similar to the lows we saw back in June, we saw a lot of buying coming in. And that buying continued in the next 2 days. And we saw one of the best days in the past 2 years on the, which day was it? The Tuesday. The XJO was, or was it the Wednesday? The XJO was up something like 3 point something percent. But again, don't forget, the best days in equity markets occur during bear markets. This is something that always happens during bear markets. We do see significant good days during these sort of events, these sort of situations. During the global depression, when that stock market collapsed, was it 1929, 1930, we saw some absolutely glorious days on the equity markets or the Dow Jones, some really big days during those bleak periods back then. During the GFC, we saw some really good days as well. And even during the short COVID-19 financial panic month, it was only a month where we saw the markets down. During that month period, we saw some really big up days, also saw some really big down days. So that is a feature of bear markets. We see some really big down days and see some really big up days, and volatility is the major feature of bear markets. When we're in bull markets, there's much less volatility. So you don't have as many down days, don't have as many up days. In fact, the market just crawls slowly up, because during bull markets there's much less fear and much less greed. And to be honest with you, fear and greed drive the share price or the volatility we see during bear markets. And if we have a look at the NDX, which is the NASDAQ 200, fairly similar signal here than what we saw with the XJO, a possible double bottom. And just like the XJO, the first double bottom was in June, and the second double bottom was about a week ago. And it does look like we're going to bounce off that possible double bottom. Unfortunately, on the Friday, some good economic news in relation to employment saw the NASDAQ down something like 3.8% and closed right on that support level, which is the bottom, or well, the double bottom. So that's around about 11,000. I think there is a good chance with this negative sentiment in the markets that we will see this support level breached on the next trading day, and whether it remains breached would have to be, or remains to be seen, because we'll have to wait for confirmation that that level has been breached. So I thought maybe 11,000 on the NASDAQ was a good support level just because there was a possible double bottom. I think the market was waiting for some bad economic news in relation to employment, because that bad economic news would be suggesting, or that bad employment levels will be suggesting, that the raising of interest rates is working. Unfortunately, it's gone the other way, and that's why the market was down on good economic news. It's just such a twisted world we're living in right now. So yes, some really good employment results in the United States. And this is an article from CNN Business. And I just like this article because they've raised a couple of interesting points here. And the title of this particular article, written by Martha White, was titled, "Why Good News for the Economy is Bad News for Stocks and the Fed." So yes, really good employment levels is actually bad news for the equity markets. And it's all because of interest rates and the possibility of the Fed in the United States raising interest rates even further. They actually mentioned this in a snippet in this particular article. The central bank has been trying to slow the economy. By raising interest rates, they are trying to slow the economy to bring back or down inflation through a series of aggressive rate hikes. But the labor market's continued resilience may force it to raise rates even further, a move that could result in job losses, which we're not seeing just yet, said Bill Northey, Senior Investment Director at US Bank Wealth Management. For investors accustomed to policies that stoke the economy, this can create dissonance. We're stuck in this odd dynamic. And I completely agree with that, Northey said. The Fed certainly doesn't want the job market and the economy to collapse. What they're trying to do is manage that decline, said Scott Ladner, a Chief Investment Officer at Horizon Investments. What they really want to see is things getting marginally weaker. And unfortunately, these good employment numbers, and think unemployment dropped from 3.9% to 3.7%. And the amount of jobs in the market right now is a little bit higher than they expected. There was another really interesting snippet in this particular article in relation to the workforce right now. There is roughly 1.7 jobs available for every unemployed person. So I'll just say that again. There is roughly 1.7 jobs available for every unemployed person. So that means unemployed people have the choice of the litter. So historically, there has been less jobs available than the amount of people unemployed. And I thought this was not going to happen for another 10 or 20 years. So right now, and something people haven't really been talking about, is the problem we're going to see in the future is there won't be enough people for all the jobs available. We're seeing that now. And if that does happen, that will force up wages, that will force up inflation. So I think it's highly important right now that we actually accelerate automation, because this is going to happen, because people aren't having children, not only in Western countries, but that lack of children being born is now being seen in non-Western countries. Mexico, Iran have seen their birth rates drop from 6 to less than 2. And the replacement level we need is 2.1. So we've seen and heard over the last few decades that the world is overpopulated. And the problem we're seeing now is, looks like that will be solved because people aren't having babies. But because of health increasing in the quality of health around the world, people are getting older and older. And there's going to be more people who are going to be retired. And there won't be enough workers to take all the jobs of those retiring. So we're going to have an increasing amount of retirees, and there won't be enough workers to fund all those retirees unless you really build up your superannuation. Another problem we're seeing in America right now is the number of people under the age of 18 is actually falling. We've never seen this in history, and that is another concern, that there's not enough people there won't be enough people entering the workforce to take all those jobs of those boomers retiring. And I think that wasn't going to happen for another 10 or 20 years. So I am surprised that's happening now. And I think this is an effect of COVID-19. So we are entering really interesting times. And right now, automation is going to be our savior. So I do find it interesting. There's a lot of people who won't go through the self-checkout at supermarkets because they think it means people's jobs are being stolen through automation. But that is something that needs to happen in the future. Automation is a necessity and something we need. So I think that if you get involved in any sort of automation, if your work revolves around automation, you are going to have it made over the next few decades. Now on to the 6 ASX companies I'll be featuring in today's video. The first company we're looking at here is Core Lithium, one of these lithium companies on the ASX. And I do occasionally have a look at the new IPOs, and there are so many lithium companies IPOing on the ASX, and this is actually a bad sign moving forward. So in the long term, I'm much less bullish on lithium than a lot of people, a lot of investors, particularly retail investors, even some of the non-retail investors, the institutional investors. Some of those guys are really bullish in regards to lithium, but I think long-term lithium prices will come back a fair bit. And it actually makes sense because the further lithium prices rise is actually bad for electric vehicles, bad for lithium batteries. That means the prices of those will go up. And not only that, the higher lithium prices go, there's going to be more competition, more companies, mining explorers onto the scene, and eventually we're going to see some of those lithium explorers go into production, and eventually we're going to see supply simply overrun demand. And don't forget, lithium is a commodity, and all commodities go through cycles, and it's all about supply and demand. So eventually we're going to see an oversupply of lithium. And don't forget, lithium is abundant. It's everywhere. It's not one of those rare earths are not rare, but it's not something that you can't find all that much of. And in fact, if I was bullish about lithium batteries, I'd probably try to trend towards more copper, those sort of things. Anyway, I think that's long term. I'm not sure about the short to medium term. I think there is still a little bit upside in lithium companies, but I would be trying to look at those lithium companies that are in production. I'm not sure about Core Lithium, but at this point in time, Core Lithium has a markup of $2 billion for a company that is generating no revenue at this point in time. I'm not sure when they're going to start generating revenue. If it's not within the next three to 5 years, I would be concerned if I was a Core Lithium shareholder. But anyway, share price really is still in an uptrend, but that uptrend is showing a little bit of weakness. And not only that, we have seen a triple top. So I've already talked about double bottom being a pretty good reversal signal, and a triple top is also a reversal signal. So even though share price had been increasing over the past few years, we have reached a point where we have seen a triple top, and the first top was reached in April of this year. Second top was a few months ago, and then just a month later, we saw another top at about $1.65. Now, share price of Core Lithium and quite a few other lithium companies is quite volatile. We saw the share price of Core Lithium drop from $1.65 all the way down to 81 cents in about 5 months, and then it rebounded back up to that resistance level. So with a triple top, that is a resistance level at $1.65. If I saw the share price of Core Lithium get above $1.65, that would be breaking that resistance level, and that would be quite powerful. The next support level is around about 81 cents, which was that double bottom we saw back in June and July. And then the next support level below that is around 69 cents. And there is quite a few support levels lower than that. So right now, the share price is sort of in between, maybe a little bit closer towards the support level than the resistance level. And it does look like the share price is going sideways. So it does look like right now, Core Lithium share price is moving sideways. The other interesting thing is I found that, and this could be just no evidence at all in this, but I have noticed there is a bit of a correlation between lithium share price of lithium companies' share prices and the overall market. When the overall market is up, lithium companies tend to do fairly well. When the overall market is down, lithium companies tend to do fairly badly. So it does seem there is a bit of correlation between share price of lithium companies and the overall market. Maybe not all of them, but some of the companies I am following, they do trend with the market. Now on to Telstra, and in fact, the next two companies, Telstra and Transurban, look fairly similar in regards to a really strong support level, and the share prices have just rebounded off that support level. So with Telstra, and I'm going to say right now, Telstra is not a high-quality ASX company. It is a low-quality company, and one of the reasons it's a low-quality company is because revenue of this company has been dropping over the last 10 to 15 years. I need to see signs that that has come to a completion, and this company can actually generate more revenue moving forward. There was a lot of chatter about Telstra about, say, 6 to 12 months ago. A lot of fund managers were in this company. They were putting buys out, and that's why we saw the share price of this company rally. But that chatter has come to an end. I haven't heard much about Telstra over the past 6 months or so, and really since that top we saw in the Telstra share price in January 2022. Share price got to about $4.30. But we have seen share price move towards a nice little support level, $3.70, and then bounce off it. In fact, over the past year, it's hit that support level 3 times, and we've seen really good bounces. The first time was in October last year, second time in June, and the third time was about 2 weeks ago. And the last 2 times, the share price has gone below that support level for a brief period of time. So there was a potential break, and that potential break failed. The first time in June, we saw that one-day candlestick. There was a really tall tail to the bottom of that candlestick. That meant as soon as the share price got below $3.70, there was a lot of buying coming in. That forced the share price higher above it, and then that buying continued into the next day. Share price rose from about $3.72 to $3.85, which is pretty a high increase in share price for one day for this type of company. And then recently, 2 weeks ago, we saw the same thing. Share price fell below that support level for a very brief period of time, and then a lot of buying came in, and the share price rallied all the way back up to $3.85. So wouldn't be surprised to see a $3.70 tested again, which is that support level. And then if the share price moves above about $4.10, that could be a time to sell out, because it does look like Telstra right now is trading in a range. And the top of the range is between about $4.15, $4.25, and the bottom of the range is $3.70. You could trade this company right now. So buy at the bottom of the range, $3.70, sell when it gets up to $4.10, and that's a nice 10% in a trade. But the length of the tops to bottoms could be a fair bit of time. So at this point in time, this is just a trading stock. There's no no uptrend in the share price, no downtrend in the share price. In fact, the share price or the shares are just going sideways. And you just see that with the moving averages here. Look at the moving averages from the start of this period all the way through to January 2022. You see a nice spread in the moving averages. That is telling us the share price is moving up. It's a well-defined uptrend. But from January 2022 to now, the spread in the moving averages is not there. In fact, you see a lot of the moving averages cross each other, and that is telling us the share price of this company is going sideways. So I personally have no interest in this company right now, either trading or taking a position in this company, because there is good value. Now onto Transurban. If you don't know who Transurban is, they own lots of toll roads. I hate toll roads. I believe all toll roads should be stricken from the earth. We should not have to pay for using roads. That's what fuel taxes are there for. Now, I have heard, received a little bit of pushback. Some people have said, well, the government can do what they want with fuel taxes. I believe it should be going to fixing roads, building the road infrastructure better than what it is now, but that's just my own opinion. Anyway, this is the Transurban share price from about February 2021. And just like Telstra, this has been in a trading range. In fact, this is a much better trading range than Telstra, because we have seen the share price of Transurban get up to as high as $14.85 on 5 occasions during the past 18 months. And each time the share price of Transurban gets to $14.85, the share price pulls back. And we have seen the share price of Transurban get to $12.30 4 times in the past, and every single time the share price of Transurban gets to that level, we see some buying coming in. So this is an instance where there's going to be a lot of traders in this company, because it's in a trading range, and where the share price gets down to the support level at about $12.30, all these traders who know the share price is getting to a support level and expect a bounce, they will come in buying the shares. And what they do is they hold as long as possible, waiting for the share price to get to the top of the range. And as soon as the share price gets near to the top of the range, they start selling. Hence why, charting works, because it's all about psychology. So someone said to me once, well, it's just a self-fulfilling prophecy. And I was like, well, yeah, that's the whole point. The movement of share price is all about sentiment. It's all about human psychology. And so when traders and even some investors see the share price get to a level that is where the company has, or the share price has trouble getting through, instinctively, subconsciously, they know that's a resistance level and they might sell. So yes, it's all about psychology. It's all about self-fulfilling prophecy. And the only way to break this cycle is for the share price to get above or break above that resistance level at $14.85 on strength, on really high volume. So that means we need fund managers wanting to buy in. And the most powerful way a share price can break through above a resistance level is on some really good financial news. So that's one of the things I really look for, is good, positive financial news for a breakout in the share price. It's one of the most powerful breakouts you can have. At this point in time, I have no interest in Transurban, lots of debt. I've heard a lot of people say this is a really good defensive play, but don't really understand why, because these companies or these sort of companies, even though they are monopolies, have a lot of debt on their books. Now on to Serko, and I actually once was a shareholder of this company, and they're sold out because they are a travel sort of company, and they were completely overvalued at one point in time. Not a lot of revenue, and when he looked at valuation, it was just insane. They did a deal with Booking.com, and this was about 2 years ago, or maybe 3 years ago. And as soon as the market saw this deal with Booking.com, they got way too excited, and the share price went way too high. Anyway, this is the share price of Circo, or the chart of Circo, going back to November 2021. So this is almost 1 year of share price action. The share price has more than halved during this period, dropping from $7.60 all the way down to $2.60. Now, the reason I've introduced or included Circo in this particular video was because we have seen another technical signal with this company over the past 2 weeks. Now, right on $3, there was a nice support level at that price. And round numbers are really strong support and resistance levels because human psychology. Investors love round numbers. So there would have been a lot of investors who were willing to buy this company at around $3 or right on $3. A lot of investors, for some reason, put in the prices of the companies they want to buy or sell at round numbers. So $3 was a really good support level. We had seen Serko reach $3. First time was in June. Then we saw, well, not a nice bounce, but it rallied for a little bit. And then we saw the share price reach it again about a month ago or 2 months ago. And then about 2 weeks ago, it hit $3 again. And then in one day, the share price of this company went from $3 to $2.60 in one day. So this was the market saying, someone in the market said, I don't want this share price of this company to remain above this resistance level. And this was a breakout to the downside. And again, just like a breakout to the upside, you need a little bit of volume. And there was really good volume on that day. Share price dropping over 10% in one day was a sign that this support level at $3 had been broken. Share price then went up. It tried to test $3 again. So whenever you see a breakout, don't be surprised that the share price will test out that either that broken support or resistance level, just like Serko did. Share price went from that $2.60 back up to about $2.95 in about 6 days of trading. But on the Friday, share price collapsed something like 10% again, fell from $2.90 down to $2.60. So not good news from Serko shareholders with this good support level being broken. But share price has been in a well-defined downtrend for just about a year right now. So whenever I see well-defined downtrends, there is no limit to how much the share price can fall. What you want to wait for is a consolidation period or some good news coming in that would break the company out of this downtrend. Now, to the completely opposite side of the story than the previous company, Serko, and that's Donaco International. They own some, maybe 1 or 2 casinos somewhere in Southeast Asia. I'm thinking Vietnam at this point in time. And those casinos have been closed for an extended period of time, and they are reliant on international visitors coming in using those casinos, probably China visitors. That's what I would be assuming. They've also had some trouble with a competing casino in the past, but I haven't really paid attention to Donaco International, what's been going on with this company for a while. Because of COVID-19, this company has seen the share price really go down a lot. We've seen the share price go down as low as about 2.5 cents or something like that. But during the week, in the past week, we saw the share price rally almost 40%. Not huge volume and not on any news, if I remember correctly. And actually definitely no news, because the company did receive a price and volume query, just a price query. Probably would have been a price and volume query, even though there wasn't really high volume, from the ASX, trying to understand why the share price rose 40% in one day. I think one of the reasons why it probably rose 40% in one day is the shares in this company are highly liquid, and particularly because it wasn't on really high volume, it was just the lack of sellers, and that what drove up the share price. probably some traders saw the share price rise during the day. So a really long candlestick. You can see that massive long candlestick. Share price rose from about 4.5 or 4.7 cents all the way up to about 6.5 cents in 1 day's trading. And the share price has sort of gone sideways since then. So this is a potential breakout in the share price. And we did see actually increasing volume after this pretty big day update. So maybe some traders have come to, well, this company have come to the attention of some traders, day traders, and that could drive the share price higher from here. Now, I'd say this company is by far a low quality company on the ASX, but for low quality companies on the ASX and other international exchanges, I am all about the share price trend and sentiment. So it does look like there is possible positive sentiment coming into this company at this point in time. So I have put Donaco International onto my watch list just to see what's going to happen over the next few weeks. Last company I want to look at is Air New Zealand. And this is the 2.5 year chart. So I wanted to show you the share price of this company as it went through the depths of the COVID-19 financial panic. Share price reached a low of 50 cents during that period, and it reached 50 cents again in about June of this year. And so that 50 cents is a really good support level for this company. So again, what's happened here with Air New Zealand? There would have been a lot of investors probably thinking as the share price fell during, say, April into June, when they saw the share price get to 50 cents, they probably remembered that the lows during the COVID-19 were 50 cents. So they were thinking, well, if the share price now is 50 cents, and that's equal to the share price that it got to during the lows of the COVID-19 financial panic, there's probably some value here. So that was the low in the share price, right on 50 cents, or just below 50 cents. Now, the share price did, for a brief period of time, get below that level, but whenever it got below that level, there was a little bit of buying. But the share price is rallying now. Share price has increased from 50 cents to 62.5 cents. So even though that's only about a 20% rise in the share price, 25% rise in the share price in about 3 or 4 months, the share price does look like it wants to turn around. There's probably some positive sentiment coming into this company right now. I think the worst of times have come to an end for this company, and there more than likely is better times in the future. If I did have a look at the financials of Air New Zealand compared to Qantas in 2019, and if both companies, what's the word I'm looking for? If both companies go back to pre-COVID levels in terms of passenger use, in terms of revenue and profit, Air New Zealand by far is looking more attractive than Qantas at this point in time. The other thing is don't like what Qantas have done, in particular with their share buyback. I think that is really bad of them to do that, particularly after they were given a lot of money from the government. So I'm not the biggest fan of Qantas at this point in time, simply because of that share buyback. I think they could have done some better things with that money. And one of the things they could have done with that money is to set aside for a rainy day. And they've not done that. They just decided to give that money back to their shareholders, because you never know when the next rainy day is going to come. No one could have forecast COVID-19, or no one would have forecast COVID-19. And there are a lot of companies out there who had no money set aside for that rainy day. And if you go to a financial advisor, and I'm assuming here, if you get any sort of advice from anyone, the first thing they will tell you is make sure you have money set aside for that rainy day. You might get fired next week. You just don't know. So you always need some money set aside for those bad possibilities that could happen in your life. And I just wished some companies did the exact same thing. And a lot of airline companies in the United States were doing share buybacks pre-COVID-19. And then they had to raise money because they were doing share buybacks. So one of the things I do look for is companies who don't do share buybacks when they don't have to. The only time I like share buybacks done is when the share price of a company is really undervalued. And Qantas is not undervalued right now, so there's no reason they have to do a share buyback. And I think the best thing they could have done is give some of that money back to the government. And I'm not going to say they stole money, because they were given a lot of money from the government, and now they're giving a lot of that money back to their shareholders. So anyway, rant ended. I probably would prefer Air New Zealand, but to be fair with you, I'm not going to take any positions in these companies. These are both low quality companies. All airlines are low quality companies. The only reason I might take a position in Air New Zealand if I see a good uptrend developing. And it does look like there is potential of an uptrend developing in Air New Zealand share price. So I'm going to keep this on my watch list. And if I get confirmation of this developing uptrend, I might take a position. That remains to be seen. That's all I have for this video, a technical update, the 9th of October, 2022 edition, looking at core lithium and 5 other ASX companies. Also looked at the NASDAQ, the NDX, and the XJO. If you have any questions, any thoughts, if you think I'm wrong, if you totally think I'm wrong on some of these ideas I've raised in this video, if you think I'm completely stupid for not thinking lithium is a long-term hold or a long-term thematic, I'd love to hear your opinion. I love to hear different opinions than myself, because that's how we learn. And if someone actually puts forward to me a really compelling argument about why I'm wrong in regards to the long-term potential of lithium companies, I'd love to hear it. So please put it in the comment section of this video. Otherwise, I'm not a financial advisor, and if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.